Welcome to the March edition of In the Know. For those of you that don't know, Ashburton Investments represents the asset management capabilities of the First Rand Group. Ashburton Investment offers solutions for the IFA market, corporates and institutions. We have a footprint in South Africa, Namibia and in Jersey. Locally, we've got over 10 years of experience and globally, we've got over 40 years of experience. Ashburton Investment has one of the strongest investment teams whose collective mission is to offer clients solutions with integrity. Ashburton Investments also has one of the most diverse investment teams in the country. Today, we've got Jared Sullivan, multi-asset class strategist. Jared joined us from FNB in 2020, where he was an economist. Jared has an in-depth knowledge of both local and global macroeconomic topics. He's also published a few papers. Today, Jared will be taking us through his views on the global macroeconomics. If you have any questions during the webinar, please send them to us via the chat, and then we'll address them at the end. Thank you, and over to you, Jared.
Hello, everyone. So in this session, we'll be going through the global market review of what has currently been happening around the world, how we've got to this point, and what the market implications will be going forward. So a good place to start is reviewing what has happened over the last couple of years among asset classes. So if we specifically look at equities and fixed income and rewind to what happened in 2022, we saw that there was one of the biggest shifts in monetary policy rhetoric that we've seen in history. So the Fed went from talking about inflation that was transitory to talking about inflation that was more sticky than what they anticipated. So as a result, we saw one of the most aggressive monetary policy shifts on record, where we saw several rate hikes, which resulted in a positive stock and bond correlation where both equities and fixed income asset classes were down for the year. Fast forward over the last couple of months, and last year and a half in particular, we've seen a stark recovery, in particular with equities, because of the favorable liquidity dynamics, because of Fed interventionism, as well as the fact that we've seen yields peak toward the end of last year, where the market is looking towards rate cuts with a lot lower inflation levels. If we take a look at the manufacturing PMIs around the world, it's very well known that we've been in some sort of industrial recession. However, there are a few outliers certainly worth noting. Emerging markets have been somewhat resilient in terms of their economic activity, and in particular, India has been a shining light within the emerging market sphere. So you can see that their numbers, which has any reading above 50, indicates an expansion of activity. So that's been one of the most resilient countries that we've seen around the world in terms of some of its data, as well as the fact that we've seen an economic recovery in Russia coming from strict sanctions to more normalized economic activity. From the services PMI perspective, we can see that economic activity actually has been more resilient on this front. And in particular, we have the same shining light India coming through quite strongly in terms of its economic activity. And again, we've seen Russia normalizing from a very strict sanction state where economic activity is also starting to pick up in these jurisdictions. So starting off and taking a deep dive into the European economy, we can see that inflation levels, like the most of the Western world, have come off their peaks. So we've seen both producer price inflation and consumer price inflation in the top left-hand corner come meaningfully down off their highs. However, CPI is still outside the upper end of the 2% target, but PPI, i.e. producer price inflation, is deeply negative. So this is certainly encouraging for policymakers, given the fact that tight monetary policy that has been affected over the last couple of years has certainly helped to bring down the inflation levels. On top of this, we've seen a lot of the risk in the European market dissipate. So if we take a look at the Italian and Germany bond spread in the top right-hand corner, we can see that risk has been priced out the market, with that spread narrowing quite meaningfully so indicating a lot more comfort amongst investors in terms of the state of the economy within Europe. If we also take a look at the PE ratio, we can also see it from a valuation perspective. It is quite cheap by historical standards. So a lot of the derating has already taken place amid very tight monetary policy dynamics. Now we're looking forward to hopefully an easier climate in the coming years. And really, to end off, if we take a look at the hyperfrequency data and focus on a lot of the confidence metrics, we can see that forward-looking indicators, particularly expectations for economic growth, as proxied by the green line in the bottom right-hand side, we can see that that has significantly increased off the lows, which makes for more optimism in the European economy heading forward. If we delve into the US labor market, we can see that non-farm payroll employment has been resilient. And if we disaggregate the data into part-time and full-time employment, more recently we can see a lot of the job gains have been initiated in the part-time employment sector as opposed to full-time. And that is particularly important in terms of having some of the labor market dynamics cool, which is a desirable characteristic for the Fed to reduce some of the tightness in the labor market. And in fact, if you actually look at the NFIB, which is the National Federation for Independent Businesses, hiring plans index, which is the association for small businesses, we can see that hiring plans have cooled off from their highs, which again is a very desirable characteristic for the Fed, for the labor demand to cool in the economy, but not to outright recessionary levels. This will help keep inflation levels at much more normalized outcomes. If we delve into the US consumer, we can see that credit card expenditure has now passed $1 trillion. And in fact, if you look at the interest cost of servicing this outstanding debt, it's at levels we haven't seen in decades, which is now north of 20% interest of servicing any additional debt on your credit card. And even more importantly, if we take a look at the total sequential change in credit month to month, if we look at the blue line, we can see that consumers have really taken up the appetite to take on more levels of credit across the spectrum there. So delving in deeper into the consumer balance sheet side of things, we can see that savings levels are now below its historical trends, and savings rates are meaningfully lower than what we have seen in the COVID lockdowns. So we can see that a lot of stimulus checks really propped up the savings rates of consumers and savings levels during that period, and now it has been meaningfully drawn down, hence the reason why consumers are taking on a lot of credit at this juncture. If we take a look at the ability to afford this type of credit, we can see that there's much more healthier characteristics among the consumers than one would appear. We can see that if you look at the red line, real incomes have gone back to its historical trend, so they have improved because of the disinflationary tailwind to restore purchasing power back to the consumer. And even if we strip out those transfer payments, which looks at the orange line over here, i.e. the stimulus checks that took place, we can see that real income levels are around their trend levels as well. So much more healthier environment overall. If we look at the outstanding debt levels and look at it in a ratio format, we can see that household debt to GDP numbers are actually much lower than what we saw in the global financial crisis in 2008. And the ability to service that debt is still sufficiently low. So if we take a look at household debt servicing costs relative to disposable income, we can see, yes, that's lift off the low, but it is not at destabilizing levels like we saw in the 2008 financial crisis. And in fact, if you take a look at household debt to disposable income as a ratio, that is also much lower than what we saw in the global financial crisis. An important factor to consider in markets is US financial conditions. One of the indicators that we track closely is the Bloomberg Financial Conditions Indicator, where it can really disaggregate financial conditions into three spheres, i.e. by looking at the bond market, by looking at the equity market, and by looking at the money market space. So if we focus our attention to the money market space, you can see traditional risk metrics have meaningfully narrowed there, such as the Treasury Euro dollar spread, the LIBOR OIS spread, as well as the commercial paper to T-bill spread, have gone on much lower, indicating increased risk appetite, increased comfort with the level of liquidity in the system, as well as the fact that the market displays a high level of comfort in terms of some of the Fed interventionism that took place for majority of 2023 in terms of things like the bank term funding program, discount windows, the drawdown of the reverse repo account, etc. have all been meaningful players in terms of adding liquidity to the global financial system. And in fact, we've seen the VIX come down meaningfully, which has helped prop up equity markets, see higher valuations through P multiple re-ratings. And even if we look in the bond market, again, risk metric spreads there have meaningfully narrowed. If we take a look at the BAA corporate to treasury spread, the municipal to treasury spread, as well as the high yield to treasury spread in particular, those have all meaningfully narrowed, indicating an increased comfort in terms of risk taking from a high yield sector perspective within the bond market, as well as the fact that investors feel much more comfortable in terms of where the level of interest rates are at, as well as the level of risk which is priced currently in the market. One area of the market where we've seen quite significant concentration, which many of us will know, is the Magnificent Seven stocks. So you can see that over the last year and a half, Magnificent Seven as a proportion of the global indexes have increased meaningfully, indicating much more narrow concentration in which is contributing to market performance. This is particularly important for us to evaluate whether this is sustainable or whether there is going to be inflection points in the future. So one of the stocks that we own in our portfolios is Nvidia. And we all know about the explosive share price dynamics that Nvidia has taken place over the last year and a half, in particular in the most recent earnings announcements, which saw Nvidia surge $277 billion in a single day. And in fact, given that the share price has been so explosive, one would think that, multiples might have re-rated. So Nvidia has gotten a lot cheaper over the last couple of quarters because of the fact that operating metrics like profit have grown faster than the share price. What this has done is it allows for sufficient entry in our Global Leaders Fund, which has helped us to asset allocate accordingly to something that we believe is a thematical theme over the long term. If we take a closer look at our global equity funds, in particular our newly launched Global Equity Growth Fund, we see that Nvidia is a top holding over there. And because of cheaper valuation metrics, this has allowed us to allocate towards this stock in particular within our Global Leaders Funds. So the difference between these two funds is the fact that Global Equity Growth searches for companies that have double-digit earnings prospects on a 3-year rolling time horizon, where Global Leaders is a much more concentrated mega cap focused fund that has a valuation criteria overlay. It's prudent to take a look at forward-looking expectations. So just to quickly reround on what happened last year, we saw that earnings were barely positive for the S&P, coming at 0.9% year on year, but investors are a lot more optimistic for what earnings prospects are going to be this year and next year if we look at the expectations within the graph. Going forward, we remain selective in terms of some of the opportunities that we see and making sure that we foresee the earnings that can actually be delivered on this front. So I think it is prudent to actually take a deeper look into some of the sectoral prospects of what is likely to happen in the coming quarters. So if we take a look at the S&P 500 earnings slide and take a look at what analyst expectations are among sectors, we can see that it is expected to increase, particularly in the second half of this year, and actually go toward double-digit earning recovery into 2025. It's important for us to analyze whether a lot of these earnings expectations are realistic, and we foresee a lot of the high beta sectors like the consumer discretionary sector, the communication services sector, which have very buoyant earnings prospects, where we think there could potentially be some downside risk, hence the selective opportunity within our asset allocation. Also, high beta sectors like IT remain yet to be seen in terms of if these earnings prospects will indeed deliver. Hence the need for a complementary top-down and bottom-up asset allocation in terms of constructing our portfolios so that we can really take advantage of companies and regions where we think these earnings are indeed likely to deliver. Taking a look at the earnings season thus far, we can see that over the last 2 quarters, earnings have started to accelerate into the mid-single digits, which is certainly encouraging. However, certain sectors like your materials, your energy, as well as your healthcare sectors have been meaningfully negative. Hence the positioning of our opportunity towards certain selective stocks within the consumer discretionary and IT, which have had much better earnings prospects to date. And really, it's important for us to focus on a lot of these earnings revisions. So we disaggregate the expectation data into quarters for the first quarter of this year, second, third, and fourth quarter, and we track this quite closely as a momentum indicator, if you will. So reviewing the net revisions in momentum, in the first 2 quarters in particular, we've seen there's been more downward revisions to earnings expectations, compared to more upward revisions. But in the second half of the year, we've had the perverse result where earnings expectations are actually forecast to accelerate amongst investors. So we think that in the second half of the year, earnings is likely to accelerate in line with what we have seen in terms of expectations over there. However, we always remain cautious in terms of some of the selected opportunities that we see, and earnings is just one metric that we follow in terms of the decomposition to total return. We definitely consider the liquidity factor in terms of whether this will be positive or negative, and is something that we monitor quite closely as well. If we take a look at current speculative positioning in the market, as proxied by CFTC non-commercial contract positioning, we can see that the yellow line on the left-hand side indicates the fact that market speculators are actually net short quite a bit of contracts compared to what has happened in terms of the more recent price action on the S&P, which has accelerated over the last couple of quarters. While this is certainly no contraindicator in particular, it's always worth following where positioning is at the extremes for sizing within our asset allocation. Similarly, if we take a look at the bond side of things, and if we look at the light red line, we can see that market speculators are also quite heavily net short the bond complex, where they likely anticipate higher yields and really do likely believe in the story of higher for longer for the Fed. And in fact, that's something that we've seen year to date in terms of the market having to price out a lot of the rate cuts to be closer to what the Fed has indicated in terms of their own dot plot. So in terms of the yields, however, we do believe that yields have likely peaked at about the 5% level sometime last year, and that we are unlikely to get back to the 5% level going forward, which would offer fixed income as a diversifiable asset class on a long-term time horizon. Delving deeper into some of the inflation statistics, we can see that CPI and core CPI have both meaningfully disinflated from their highs. That's particularly important for the Fed in terms of some of the tight monetary policy that they inaugurated over the last couple of years starting to filter through in terms of a disinflation trajectory. However, we still remain concerned that inflation may likely settle at a higher level, and it's something that we monitor quite closely. And in fact, if we take a look at the last two inflation prints in particular, we saw that those were both upside surprises relative to Bloomberg expectations. And even if you take a look at the closely watched metric, which is the personal consumption expenditure price index, as well as the core inflationary component there, it is encouraging that it has disinflated, but we just remain concerned about what level this will settle at, because the Fed's desired target is to achieve back toward 2%, and we think they're unlikely to cut in the absence of any fragilities in the global financial markets, and they will remain patient in order to achieve their 2% outcome. So if we take a look at what the market thinks about this in terms of what is happening to break-even inflation rates, we can see more recently there's been quite a significant spike in the one-year break-even inflation rate, close towards 4%, indicating a degree of discomfort on what is happening in terms of some of the inflation statistics. And in fact, if we look more broadly of some of the inflation statistics like the University of Michigan Consumer Sentiment Survey, some of what is happening in terms of selling price expectations from a small business front, it does indicate that inflation is settling at a higher level, which will be cause for concern in terms of what the overall inflation complex will be in a future state. So one of the prudent measures that we take is really trying to quantify what the year-on-year inflation prints will be in the coming year. We take a look at the different assumptions from a month-on-month perspective, from all the way from 0% month-on-month up to 0.5% month-on-month acceleration inflation, and what that will transfer in terms of what the year-on-year number will be from an inflationary standpoint. And you can see that in the table, if we start to see 0.3% month-on-month readings in inflation, indicating, this really stickiness and sequential expansion in inflation, then the year-on-year numbers are going to stay above the 2% inflationary outcome, which will be an undesirable characteristic for the Fed and will require a policy response. If we take a look at the overall level of yields in the fixed income and corporate world, we can see that they are meaningfully higher compared to what we have seen in the past couple of decades, and more recently so. Despite some of the inflation wobbles that we've seen more recently, we can see that yields have come off their peaks and are much more attractive levels. The question remains, however, is whether yields will reprice further upwards in terms of maybe pricing out some further rate cuts that the market has priced in, and this will indeed affect the capital bond component of the fixed income complex. So it's important for us to monitor what the short-term effects will be in terms of bond pricing, because if yields do reprice higher, there will be a capital loss within the fixed income complex. But if the market is right and starts to price in even deeper rate cuts going forward, we would expect that the yield component in a lot of these securities would come down, adding to the total return complex within the fixed income world. So it's important that we monitor these developments quite closely. In fact, we do a scenario analysis daily where we take a look at what the fixed income return will be given the level of yield that is prevailing in the current market. So one of the main indicators that we look at is the US 10-year rate, which is currently yielding at about 4.2%. And we do scenario analysis to say, okay, what would this give you in terms of its holding return dynamic if yields either had to sequentially decrease or sequentially increase? So if we look on the left-hand side, our assumption set really goes down in 20 basis point increments to about 4%, 3.8, 3.6. And then next to that, you would see the holding period return that one would receive by investing in this component. So double-digit returns are expected if yields really do fall close to 100 basis points from these levels. However, if the perverse had to happen, and we see yields go higher to 4.4, 4.6, and about 4.8, you still generate positive holding period returns on a 1-year time horizon. However, these start to become negative once the 5% yield level is reached. So this really goes to show you how important the coupon component is in the bond market, because of the fact that the coupons are issued at a much higher rate compared to what we've seen over the last couple of decades. Taking a look at the interest rate outlook from a futures pricing perspective, we can see that the consensus amongst the Western world is for rate cuts to transpire in the United States, the United Kingdom, as well as Europe. However, the question of the magnitude of these rate cuts is certainly important for the capital component within the fixed income complex. So we've seen the market over the last couple of weeks move much closer to what the Fed have articulated in terms of 3 rate cuts being priced in for 2024. So this leaves us with a higher degree of comfort in terms of what the Fed and the market are pricing from a much more realistic standpoint compared to the beginning of the year, where roughly 7 cuts were priced in. If we take a look at different fixed income instruments and see how their total returns have fared over the last couple of months and quarters, and even the last year, we can see that risk has actually been endured in a lot of the higher duration assets. So in fact, if we take a look at our 20-year duration bond, we can see that not only have the returns been negative, but the implied volatility of this instrument has been a lot higher compared to your riskier type of asset classes like your convertibles, your fallen angels, as well as your high yield in terms of the return that they have delivered with lower levels of risk. So this is certainly unconventional in terms of your traditional sovereign government bonds being a shock absorber in times of economic turmoil and economic uncertainty, because of the fact that we are now in a bit of an inflationary world where capital loss has been an important driver of some of the higher duration assets that have been deemed to be safe in the past. To really summarize on what the Fed have done in terms of their latest FOMC meeting, we can see a number of noteworthy events have taken place. Importantly, we saw that the Fed did acknowledge that the disinflation trajectory has been meaningful thus far. However, more data is needed for their degree of comfort before initiating any rate cuts. Importantly, however, though, Jerome Powell at his latest press conference did articulate the fact that a lot of the members did have a degree of comfort in terms of cutting rates this year. However, the magnitude of rate cuts remains in question, and the timing of these rate cuts certainly remain in question. And it's not just an inflation story. If we take a look at the labor market dynamics, what the Fed members really want to see is there be a reduction in labor market tightness to take place so that they can have a higher degree of comfort to inaugurate rate cuts so that inflation levels can cool at more sustainable levels going forward. And if we really disaggregate the goods and services component of the Fed's view, the goods side of the equation, the Fed expects that inflation complex to go from negative to hovering around 0%, while the services element of inflation is still somewhat sticky, and the Fed would like to see more disinflation take place on the services front there. And in terms of rate cuts over the next couple of months, We saw that Fed Powell did push back on any March rate cuts, so we've seen the pricing be priced out for a rate cut in March there, which is much more realistic given what the Fed have been communicating. And what is new and exciting in terms of the latest developments for the next meeting is the fact that we do expect there to be more information on the balance sheet runoff process. So specifically, we expect the degree of tightening that has taken place through the balance sheet runoff process to be reduced. So currently they are taking off $95 billion worth of mortgage-backed securities and sovereign government bonds at this stage. So we expect that $95 billion to be a lot less going forward, but still be on a tightening path. If we take a look at how money markets are dispersed globally, we can see that global money market assets have passed $6 trillion. So if we did have to see rate cuts over the coming years, in line with much lower inflation levels, this would be a good catalyst for money to find its way back into equity markets, which can both help from an earnings perspective and a multiple re-rating perspective. However, at this juncture, money market assets do yield north of 5% with a lot of the treasury bills outstanding there at this moment in time. Hence, it is not surprising to see a lot of the flow dynamic increase more meaningfully over the past 2 years in particular to global money market assets. If we take a look at the outstanding government issuance of debt, they've been particularly selective in issuing their debt at lower tenured securities. So in particular, if we take a look at the T-bill dynamic, we can see that now makes up a greater proportionality of total outstanding government debt, which is made up of the red complex in the stack chart over here. That is particularly important because of the fact that this provides very good signals in terms of maybe what the government expects from an interest rate dynamic going forward. Because of the fact that they've really issued a lot of short-term paper, it could well mean that they expect interest rates to come down in the future so that when this debt comes due, they effectively can roll it at a lot cheaper interest rates, potentially over the next couple of years. And if we take a look at the detail of the latest Treasury Quarterly Funding Report, we can see that borrowing needs are meaningfully less compared to previous forecasts. And in fact, they're $55 billion less for the first quarter in terms of market borrowing needs for the fiscus. Also, we've seen a series of short-term stopgap funding deals being announced to keep the government afloat to prevent a government shutdown. And we've seen the most recent announcement that this will likely be extended to keep government afloat till about September this year, which is encouraging and takes a lot of uncertainty away from the market. However, given the fact that it is an election year, we see that the fiscus, in terms of the intended trajectory, may not necessarily keep to the planned intended schedule. So, in fact, we actually might see a bit of a deviation and the fiscal impulse be still net positive heading in toward the elections. If we take a look at the Treasury financing schedule, again, to reiterate, we see a lot of this debt tenured at the lower tenured paper. So at the 2-year, the 3-year, and the 5-year is a lot heavier compared to the middle and longer duration assets on the 20 and 30-year bond dynamics. Again, this is so important because of the fact that this could potentially signal that the government in of itself expects lower interest rates, where the effective interest cost of borrowing might be lower in the longer term because of the fact that when a lot of the shorter term paper comes due, they can roll it into lower interest rates in the future. We can see that the US government's interest burden, regardless of this issuance, has grown meaningfully because of the fact that shorter term paper has a lot higher interest cost in terms of the offering that it is given to current investors at this juncture. So you can see that interest costs have lifted meaningfully as proxied by the orange line, and the interest payments as a proportion of GDP is certainly expected to balloon over the next calendar year. So this is expected to be more meaningfully higher. However, if interest rate cuts are delivered on, then we can see that interest rate payments stabilizing at a slightly higher level, but not something that is too destabilizing from a global market standpoint. If we take a closer look at China now and look at the PMI numbers, it's been a pretty mixed bag. If we rewind to the start of 2023, there was a lot of euphoria around China coming out of its lockdowns that were expected to benefit both growth and the equity market, and to have a lot of fiscal stimulus take place to support both of these aspects in terms of share price appreciation as well as much higher growth coming to fruition. However, authorities did disappoint in terms of some of their growth targets and lack of stimulus efforts compared to the Western world. If we fast forward to today, we see that there is still a bit of a recovery in China, but it does remain fragile. In order for us to review China, we need to review the hyperfrequency data and whether this is sufficiently priced in terms of equity market dynamics or not. So more recent data has surprised to the upside if we look at the China City Economic Surprise Index. And it's also encouraging that we see the throughput in terms of passenger railways through Beijing actually be meaningfully higher compared to what we saw in the lockdown period, and sustainably so, as well as the fact that we've seen household deposits cumulatively increase, which provides the level of spend for the consumer to go back into the economy if confidence is indeed restored. If we take a look at what's happening in terms of the inflation dynamics, it's quite different in China compared to the rest of the world. We see that producer price inflation is negative, CPI has just gone back into positive territory, but we're still experiencing housing deflation. So really this allows for a lot of stimulus efforts to take place on the monetary policy side of things, which a lot of activity has taken place thus far. Some of this activity that has taken place, as we can see on the slides, is the fact the reserve requirement ratio has been cut for both small and large banks. This allows liquidity to be freed up so that banks can be able to lend back into the economy. We've seen a lot of repo injections take place, as well as the fact that we saw the most recent cut in the 5-year loan prime rate be one of the biggest that we've seen in terms of the monetary policy actions over the last couple of years. So it really does indicate a direct intent from the PBOC to stimulate, prop up the economy, and get inflation back to higher levels towards their 3% target. If we take a look at what's happening in credit markets, specifically China high yield, we can see that the yield in that sector has come meaningfully down. And this is very important because of the fact that a lot of what makes up the high yield sector constitutes of financials as well as real estate dynamics. And the fact that the yield has come off from its highs indicates a degree of recovery within these markets, which is certainly encouraging, but it certainly has settled at a much higher level. So that does indicate a degree of uncertainty still amongst investors, but it is encouraging that it is certainly off the highs of north of 30% of what we've seen in recent years. And if we look at the high yield sector in the US, we've seen that it's been pretty stable at the higher levels that it has obtained more recently, and not necessarily accelerating higher because of the fact that the market has a degree of comfort in terms of some of the Fed policy dynamics going forward. If we take a look at the divergence in terms of stock market performance between China and emerging markets, we can see that China has displayed a bit of a recovery more recently because a lot of the front-loaded stimulus efforts that have taken place on the monetary policy side. So that is encouraging, but we still acknowledge the fact that China is fragile at this state, and more will need to be done to have a tangible recovery. So really what we want to see is we want to see confidence restored, and we want to see less haphazard policy pronouncements take place so that investor flows can go back into the region. And really, if we split up the emerging market sphere and take a look at the difference between China and India in particular, we can see that GDP per capita growth in India is expected to be faster in the future compared to China. And this really comes down to demographics, where India has a much more sweeter demographical sweet spot compared to China in terms of its labor force participation rate and population pyramids. So in India, you see a much more evenly dispersed population pyramid compared to China, where they have a more elderly skewed demographic. And this is particularly important for potential growth rates because with India, you can see the fact that the labor force participation rate will have much more impetus to grow because of a lot more middle-aged population, i.e. in the workforce, compared to China, where a lot more of the population pyramids are skewed towards the elderly demographic. So that really has the potential to lift potential growth rates if population pyramids are mainly geared within the working age population. And in fact, last year was the first time that we saw India population cross Chinese population, and it's forecast to continue accelerating relative to China's in a future state, indicating that growth dynamics from a potential growth perspective might be more, it indicates that in a future state that growth dynamics might be more favorable for places like India compared to China, structurally speaking, because of the fact that labor force participation rates will likely be more supportive of higher potential growth rates on a long-term time horizon. So really to end off, we really want to display some of the thematics that we see playing out on a short, medium, and long-term time horizon. So from a short-term time horizon, we do expect a lot of this excess liquidity that we're seeing in the system to be reduced. So that would likely keep cash rates still attractive at about 5% in the T-bill market, which has been a very good investment over the last couple of years. And the fact that we expect core inflations levels to actually cool to more normalized levels because of some of the tight policy dynamics that have taken place in recent years. From a more medium-term time horizon perspective, we see that inflation and growth prospects will likely normalize, where we will see much more normalized growth and much more normalized inflation levels compared to what we've seen in terms of the boom-bust cycle from the COVID lockdown periods to after. And essentially, we're likely to see thematics playing out like the onshore beneficiation of essential goods, really to hedge against those supply chain deficiencies that we have seen in the market, particularly during the COVID lockdown period. And from a longer term time horizon, we really expect rather a lot of investment to take place in businesses that will encourage virtualization, digitization, as well as the fact that those that invest in location agnostic working models will likely endure cheaper costs as well as more sustainable business models in a future state. Thank you everyone for your time. Really appreciate all the listeners on board today. And now back to you, Voya.
So Jared, here's a question that we had from the chat. What are your views on DM equities versus EM equities?
This is a very good question. So this is where top-down and bottom-up philosophies really need to come together. And you can see that in the developed market stage, that equities appear to look overvalued in terms of some of the PE ratings compared to what we have seen historically. So this is important from a risk mitigating factor in terms of some of the allocation and how heavy we need to be within these certain securities. However, we see that the liquidity impulse is much more favorable in the developed market stage in terms of some of the clever mechanisms behind the scene to prop up and shore up liquidity dynamics. And these speak to things like the bank term funding programs, the discount windows that have helped P multiples re-rate, that have kept equities trending high in the developed market world. Hence the reason that we still see short-term opportunity there, because we think that liquidity conditions, at least in the short term, are going to be supportive before they are indeed reduced for inflation to be back at sustainable levels from 2% onwards. If we look at emerging market equities, we can see that they're historically undervalued from a valuation perspective. However, there is some fragility in terms of China, which makes up about a third of the emerging market basket. So from a bottom-up perspective, we remain very selective in terms of the type of stocks that we hold within the emerging market complex from a global asset allocation perspective. So these are stocks like Alibaba, which have had very good free cash flow generation over the past couple of quarters that really need to see confidence restored for the valuation multiples to re-rate. So we do see some selected opportunities in emerging market. So that's where we need to be particularly cognizant in terms of whether economic recovery is going to take place, and we do see one in China, although it is certainly fragile at this stage.
Thanks for that, Jared. Another question that's popped up is obviously SA investors have predominantly gone global equities with their offshore allocation. What other asset classes are looking very attractive at the moment on the global side?
That's also a very good question. So in terms of having a well-diversified portfolio, that's why instruments like cash, which haven't given you any yield in decades, are much more attractive, where we see in the treasury bill market in particular, yields of north of 5%, which is something we haven't seen in decades, which offers a nice cushion towards investors from a diversification perspective. And on the alternative front, we see different types of instruments like a long short fund that we hold in terms of our asset allocation at this juncture, which really helps to diversify against market risk and is beta neutral, which makes up our asset allocation in terms of some of the holdings that we have offshore. So this really reinforces the idea of having a well-diversified portfolio that consists of equities, fixed income, cash, and even alternative products, so that it can actually generate superior returns on a long-term time horizon.
Thank you, Jared, for your views and insights on the global macroeconomic landscape, and also thank you for joining us today. Please do join us for the next edition of In the Know in April. If you do have any further questions or you'd like to find out more about our products and solutions, please do contact us. Thank you.